This is our Forex blog for May 16th, 2013, and I think 1 or 2 days this week I didn't do a blog video. I'm working on creating automated trading systems, and basically in the process right now of tearing apart some of them I've created to create a more modular approach. It's much easier to have multiple scripts that communicate with each other. It's much easier to fix bugs, update and add functionality to scripts that are 1,000 or 2,000 lines versus 10 to 20,000 lines. It just becomes a nightmare. So anyway, that's what I'm doing with most of my time. Doing the blog video every day oftentimes comes late, and some days I just don't feel like doing it. But there's plenty of older videos that show our software works, and the only real purpose of the blog video is to show new traders that we have tools that will help them trade, and also our existing clients on how to use them to trade and make money. So these are our currency indexes, which basically shows a chart of each currency. This is the dollar, the yen, the euro. And so, for example, with the euro, it gives you a wealth of information on the chart. It shows you the previous day's high right here, previous day's low in red, the point of control, which is the price most traders had positions in the euro for the previous day right here. You can see it was down 6 pips yesterday from the previous day. And these are major areas of resistance and support. This orange one is the previous week's most actively traded price, and you can see last week it went up 77 pips. So last week was a pretty decent up week. The pound went up 79 pips last week for the index for all the euro pairs as a whole. And these are very critical because it's where most traders have positions for the previous day or the previous week. So if it's above the previous week's point of control, traders last week have positions here. That's the most actively traded price. Above that, everyone who's short, the vast majority of people from the previous week, are losing money. Below that, the longs are losing money. So it's always good to know where people are making money and losing money. And you will see that it makes a wonderful filter. Underneath the point of control, you look for shorts. Above the point of control, you look for, obviously, buys. It's that simple. Currencies that are above the hourly moving average in gray tend to be another filter. You want to look for buys, and below look for sells. So let's scroll back and take a look at some of the trades earlier. One of our new traders mentioned something that I've always taught, but may have forgotten to teach for a few months, and it's very key, and that is a retest. In other words, you don't get into the first move, you wait for confirmation and look for the second wave of the trend. Now, personally, I tend to get in on the first wave because there's certain patterns that are very high probability, like a rectangle pattern. Anytime you see a multiple hour, very low volatility, choppy up and down, doesn't move much, rectangle breakouts tend to precede trends. And maybe not the biggest trends like you can see here in the Swiss, but it did go up for about 45 minutes to an hour. You can see the Australian. It continued down, and you have another rectangle pattern, and then it continued down again. The New Zealand, same thing. The CAD, the pound. So anytime you see these patterns and it breaks out, and especially when it breaks out and goes above a very key resistance area, this is pretty major. This is where most traders have positions last week. So underneath that, traders that are short from last week are making money, and above that, traders that are short are losing money. So they're going to be rushing in to buy. There's going to be stops pretty near this area, and that's why I use these. Not only do they work to support resistance, but when busted through, it tends to lead to stops. So basically, in a nutshell, you have the dollar breakout here at 2. You want to be buying. The euro dollar at 130. This one broke down last night, and so you could be looking for Australian dollar sells, and at 130 right here or close to 2, the New Zealand breaks down. So we could be looking for pound New Zealand buys, euro New Zealand buys, and New Zealand dollar sells. It's that simple, and amongst many other currencies to trade today. So let's take a look at the euro New Zealand. It's going to go up, and we know pretty much around 130 or so. You also have a nice little breakout here. This is hourly moving average, so when it breaks above that, that's a pretty high probability. And here's a nice little flag pattern, also a little wedge pattern. I tend to not want to get into trades that are above our 2.0 band, but you can certainly buy right at that level. I would be very hesitant to be buying up here. This pullback here is a little bit safer, but I would much rather wait for price return into the containment bands and then look for buys. You know, this one right here is very high probability because the perfect oscillator is showing a minus 80 level. Anytime that gets to minus 80 and the trend's up, it's pretty high probability buy, even though these are very relatively small 25 pip moves. So let's take a look at the euro, or I'm sorry, the pound New Zealand. Strong pound, weak New Zealand. You can see this one also went above the hourly here and just exploded. That's a trade I would have taken. This little wedge pattern right here, and also a nice little flag pattern right here, are all trades. I probably would not have taken this trade right here, although if you look at our perfect oscillator, it's very close to the minus 80. So if you are ever going to do something very, very risky in buying above our 2.0 band, at least make sure the perfect oscillator is very close to minus 80. Again, minus 80 right here, pretty decent place to buy, and it goes up 50 or so pips. Now remember, the dollar also broke out to the upside, so the New Zealand was weak. We sell the New Zealand dollar. You can see that breaks the hourly right here, falls about 20 pips. Here's a nice, very high probability trade. Anytime you have a pullback where the perfect oscillator hits the upper band when the trend's down, it's a pretty high probability trade. Now again, you're not going to be doing that way underneath here. Wait for, at the very minimum, a plus 80 level, and you can see this only fell 10 pips on it. Why? Because the market's down too much. You're better off kind of waiting for some kind of double bottom or a false breakout at an extreme low again, and look to maybe buy here with your stop underneath here, because it's more likely to bounce than reverse. And of course we have a trend that's down, right? And so notice this move right here is at the plus 80 level. Pretty high probability place to sell, even though it only fell down 20 pips. Again right here, it fell only 15 pips, and again right here. But if, as you notice, every single one of those caused a reversal. Why? Because the trend's down and the market is at a statistical extreme level. And here's another one right here. You can see price kind of went sideways at that level and then down again. Perfect oscillator is a wonderful companion, should be on everyone's charts. The currency index is very powerful. It can be used in many ways, and let me just showcase some of them that I don't always do. One of them is our trend channels. You draw a trend on here, then you project it from the high, and most of the time at the upper quadrant you can look for sells. Now this one was so strong that it went up even more, hit our 2.0 containment band. But at 830 right here, this one's very likely to reverse. So which currency is maybe down too much and is likely to reverse? Between the New Zealand and the Australian, I like the Australian better because the Australian actually made a bounce up. It actually had some buying here. It also wasn't able to hit the 2.0 lows. And so I would consider maybe buying the Australian. The yen doesn't look too weak at that time. The dollar's pulling back, so I wouldn't sell that. The euro's still strong. So you could consider selling, or I'm sorry, buying the euro Swiss at 830. Also selling the Swiss yen. Let's take a look. The euro Swiss at 830. As you can see, we're looking to buy this because the euro is strong and the Swiss is likely to bounce. The reason this is going down is because the Swiss was stronger than the euro. Even though the euro was strong, the Swiss was stronger, and that's what was causing this to go down. Notice at this level, the perfect oscillators here. I would prefer this be right near the 2.0 band, but guess what? It went up 20 pips in about a half an hour. Anytime you can risk 5 to 8 pips and make 15 to 20, it's a good trade. And again, notice this pullback right here, perfect oscillator. This is the kind of stuff that I start to usually scale into trades on. Good for 30 pips. Again, right here, you get it in, and this is, it's most of the time it's very hard to pick an exact low. So I tend to, when I see it kind of going sideways, I would probably get into a little bit of a trade here. Goes down a little bit more. I would always draw my fibs on there from the previous swing to get an idea of where to look for. And I was definitely getting into a trade here. Sometimes it doesn't hit the fib target, so now that I have the fib target on there, I would probably, on this green bar somewhere in here, for example's sake, maybe buy one lot. Comes down here, I might buy two. If it hits a 1.618 layer, I might buy 3 more lots. And so by buying progressively lower at these extremes, and especially at fib targets, let's say we got into the next trade down here at 23.75 or something, it would basically yank, you get in here and then here, and that lowers your average entry to right here, and it starts going up, and you're very quickly in the money. Depending on the velocity of it going up, determines how long you stay with it, but a good profit target for a counter trend trade is the upper Bollinger Band on the perfect oscillator, and you get out. So let's say you went to get in again here at the double bottom, you're in. As you can see, it quickly hits the perfect oscillator's upper band, but you're not buying at an extreme like this, so I'm just kind of going to trail my stop underneath each bar's low, and then once it moves up 10-15 pips, kind of runs out of steam or hits the plus 80 level, I probably would get out of my trade right here. I would have missed an extra 10 pips, but again, in doing counter trend trades, you got to be you have to have very little amount of greed, take whatever the market gives you. But the trend channel is an excellent way of determining reversals. Another one of those would be to draw your fibs on a move, and you can see the CAD, the daily trend's up, the weekly trend's up, comes down to a fib target. We have major support of the point of control right there, 830. CAD's very likely to go up, and we already know that at 830 the Swiss was likely to go down, so we can be looking at a CAD Swiss buy at 830. You're probably going to make 20-30 pips on this. Alright, so here's the CAD Swiss. Notice the chart. A couple things this has going for us. At 830, it's underneath the 2.0 band. It's also at an extreme here. It also had an extreme earlier. You can see right here. And if you drew your fibs off that previous down move, you can see that you're not only at 830, the lower fib targets underneath this, you're also close to the 1.618, which in my experience, probably 75 to 85% of the time, depending on the day and the currency, you'll get a bounce off of. So excellent place to be buying. You can predict pretty much a reversal in the CAD up and a Swiss down, which would make the CAD Swiss go up, and you can see it did go up 10, 20, 30 pips. This is one of those trades where you're actually in right here, and you can always progressively scale in if you want to. In this case, it wouldn't have given you the opportunity to. You put your stop a little bit underneath here if you want to, or if I was going to scale in, I probably would scale in again at 94, 30, 15, and even 9400. Whole numbers and half numbers tend to be major areas. So you can see nice little pop here. And that's how you use our currency indexes to anticipate future trend direction. Fib targets of individual currencies, trend channels, upper and lower 2.0 bands. Notice the dollar here, it never went above it. Pretty much most of the currencies that did go outside their 2.0 white bands kind of either went sideways or eventually reversed. Usually it's only a matter of when and not if.